everyone, I'm Jun, a researcher with The Expert. Electric vehicles have undeniably gained considerable attention in recent years. Meanwhile, several tech giants, including Tesla, have recently disclosed their earnings reports. Let's take a closer look at these reports and uncover what they revealed about the current state of the electric vehicle industry. Tesla stocks dropped following a cautionary note about a significant dip in sales growth this year. The reasons cited were a decline in demand, increased competition, and the ongoing impact of consistently high interest rates, which overshadow the impact of several price reductions. Tesla faced a slowdown in revenue growth and a decrease in gross margin during the last quarter of the year. The revenue increased by only 3%, reaching $25.2 billion, which is the slowest growth rate in over 3 years and fell short of the expected $25.6 billion predicted by analysts. The gross margin for the quarter stood at 17.6%, lower than the Wall Street estimates of 18.3% and a notable drop from 23.8% the previous year. Several factors contribute to the challenges, including price cuts, higher spending on research and development, and expenses related to scaling up the production of the new Cybertruck. Tesla also highlighted that capital expenditure, including investments in future projects, reached record levels and is expected to surpass $10 billion in 2024. Despite being one of the most profitable car makers globally in 2022, Tesla's margin from vehicle sales have experienced a nearly one-third decline in the past year, now aligning with those of other major competitors. Elon Musk, Tesla CEO, announced plans to commence production of a new, more affordable car in the later half of 2025. This initiative, initially proposed 5 years ago, will incorporate revolutionary manufacturing technology aimed at reducing the model's overall costs. In its shareholder letters, Tesla outlined that the vehicle volume growth rate in 2024 might be notably lower than the previous years, as the focus shifts towards launching the next generation vehicle at its Texas factory. This strategic move comes amidst concern reflected in Tesla's recent earnings about a slowdown in global demand for electric vehicles. The world's most valuable car maker appears to be entering a new phase characterized by lower sales growth and margins, marking a departure from the rapid growth it experienced in the previous years. It's a pivotal moment for Tesla as it adapts to the evolving market dynamics and positions itself for the future. Tesla successfully achieved its goal of delivering 1.8 million cars in 2023. However, unlike previous years, the company did not provide a specific delivery target for 2024. Wall Street analysts have estimated that Tesla may sell around 2.2 million vehicles in 2024, representing a modest increase of about 20%. This figure is notably lower than the ambitious 50% annual growth rate that Tesla committed to 3 years ago. The electric vehicle market has witnessed a surge in sales, reaching record levels globally. However, the pace of growth has been slower than anticipated, primarily due to mass-market customers hesitating to embrace EVs, largely due to comparatively high prices compared to traditional petrol alternatives. This trend has prompted several EV manufacturers, such as Ford and General Motors, to scale back their expansion plans. Hertz's recent move to shrink its electric fleet by selling 20,000 electric vehicles is indeed noteworthy. The decision was attributed in part to what Hertz CEO Mr. She described as unprecedented price cuts by Tesla, which significantly impact the resale value of Tesla vehicles. Tesla implemented substantial price reduction of around 30% last year, causing a sharp decline in the value of existing Tesla cars. The fundamental economics at play are interesting. When price of new vehicles undergoes a drastic reduction, it tends to drive down the resale value of used cars. Buyers are then inclined to opt for the newer models at the lower prices, affecting the overall value of pre-owned vehicles. Hertz's adjustment in its electric fleet strategy sheds light on the intricate relationship between new car pricing, depreciation, and the dynamic of the used car market in the context of electric vehicles. This could also drive savvy buyers to wait for price of cars to stabilize before making the transition to EVs. The main factor influencing consumers' decision on electric vehicles purchases is affordability, according to studies by S&P Global and Deloitte. The lack of low-cost options is discouraging customers from transitioning to EVs, with the average price of an electric vehicle around $50,000 in September 2023, as reported by Kelley Blue Book. This situation is pressuring manufacturers to either rapidly increase productions at significant losses or slow down the shift to electric powertrains. Recent actions like GM scaling back Cruise and Ford reducing productions of the Lightning suggest a potential leaning towards traditional powertrains, possibly solidifying Tesla's market position. Although Bloomberg NEF predicts a global unit growth of 25 to 30% in 2024 to 2025, Tesla's ambitious goal of 50% annual production growth appears to be very challenging. Competitors from Acura to Volvo are gearing up to flood the market with new EV products by 2025, creating a competitive landscape that may affect Tesla's market share. The success of Tesla's lower-cost Model 2 and updates to its aging product line is crucial in navigating this wave of competition. In response to market dynamics, Tesla has strategically reduced price for its popular Model 3 sedan and Model Y SUV. This move not only boosted Tesla's sales but also compelled other automakers like BYD, General Motors, Hyundai, Ford, and Volkswagen to adjust their pricing as well, contributing to overall affordability of electric vehicles. However, these price cuts have come at a cost, impacting Tesla's profitability. Let's briefly look at other brands too. Ford's shares in the electric vehicles market is expected to stay below 5% until 2025, with its current EV models facing a concerning EBIT margin drop of 75% post-price cuts. These models, based on the older Generation 1 platform with outsourced batteries, are witnessing reduced production due to declining demand in the US, aimed at minimizing losses. The upcoming Generation 2 models, including Project T3 and Explorer EV, boost an in-house battery and a cost-efficient design, potentially helping Ford to recover from EBIT losses. The positive shift in Ford's EV sales performance is anticipated, particularly post-2025. Despite these efforts, EVs are projected to contribute less than 6% to Ford's total automotive revenue until 2025, slightly below the consensus of 7.8%. The introduction of Generation 3 models is expected to bring cost improvements, potentially boosting volume and sales. However, they may not become top-selling models until 2027. Intense competition in the EV market, especially with launches from GM and other competitors, could impact pricing for Ford's upcoming models in 2024. Additionally, the popular Mark E models is set to lose EV tax incentive eligibility. Ford's EV business segment might still incur losses with a projected EBIT margin of -44% in 2026, compared to an 8% target. Scale benefits may be limited until 2027, when lower-cost models are expected to be produced in significant volume. Higher costs following the recent UAW contract could further impact margins. Previous guidance for breaking even by 2026 assumed elevated EV prices, but reduction in 2023 and potential headwinds from competitors could pose challenges. Looking at the upcoming EV models chart, it's evident that a significant concentration of launches is slated for 2025, including one from Tesla with the codename Redwood. During the recent earnings calls, Musk gave a heads-up to Tesla workers, cautioning them to brace for a challenging production ramp-up for their ambitious plans to to build a mass market vehicle, which will be priced around $27,000. The next generation EVs is scheduled for productions in 2025, with Musk emphasized that the intensity of the project, stating that Tesla engineers may need to live and sleep on the manufacturing line at the company's Texas factory. In Musk's own words, we really need the engineers to be living on the line. This is not sort of an off-the-shelf, it just work type of thing. While the overall outlook for the far future may seem positive, for many electric vehicles companies, including Tesla, are expressing a more negative view for the upcoming quarters. So, if you are trading Tesla or similar stocks, it's crucial to be cautious. Looking at Tesla's prediction for the next quarter, it seems that the sales of their popular cars, the Model 3 and the Model Y, could experience a slight decrease of 1.49%. The Model S and Model X, on the other hand, are anticipating a more significant decline of over 22%. Oh, and by the way, Cybertruck is set to start deliveries in the next quarter. On the other hand, for Tesla's major competitor, BYD, the outlook doesn't appear too optimistic either. Despite impressive growth in the past few quarters, there are concerns about a substantial slowdown in the future. The projected basic EPS is expected to decrease by around 40% in the first quarter of 2024, accompanied by a more than 22% drop in vehicle sales. Unless there's a significant impact from stimulus measures in China, the prospect for the company might continue to be gloom. Thanks for joining me today. I hope you have gained insights from today's video. Everything I've shared are information that I've picked up and learned, sprinkled with a bit of my own takes on things. When it comes to trading or investing, do your own due diligence and be mindful of the risk. If you find the video helpful for your research, don't forget to share it with your friends as well. They might find it useful too. Quickly access to all of our channels by scanning the QR code. Take care, and I'll see you in the next episode.